Over the weekend, global tensions escalated sharply as conflict involving major powers intensified. In this video, we're going to break down what actually happened, why oil matters more than most people think, and how gold, silver, and platinum behave differently in crisis, and what this means for global stocks going forward. I am Ravi Naika. I'm a chartered accountant, an ex-banker, and a fintech executive. As always, markets didn't wait for political clarity. They reacted immediately. Within hours, we saw a classic risk-off response. Oil immediately spiked on concerns, and gold and silver surged as capital moved towards safety. Equities, particularly high growth and rate-sensitive sectors, came under real pressure. Now, what we saw was that volatility rose, and now it's important to understand something absolutely fundamental. Markets don't move because of headlines alone. They move because of uncertainty. When the probability of disruption increases, whether it's supply chains or inflation or interest rates or global trade, institutional capital adjusts first, and it adjusts fast. What we witnessed was not panic, it was merely repositioning. Energy was bid higher because war introduces supply risk. Gold rallied because investors look for preservation when confidence drops. Banks and high beta equities softened because they're sensitive to growth and rate expectations. This is the mechanical playbook of global markets. So let's take a step back for a moment. Why does escalation in the Middle East matter so much to global markets? Because this region is not just politically sensitive, it's economically systemic. Roughly a third of global oil supply flows through the Middle East. The Strait of Hormuz alone is one of the most important energy choke points in the world. If that corridor is threatened, even indirectly, energy markets reprice immediately. At least 20% of the world's oil flows through there. And energy is not just a commodity, it's an inflation driver. It feeds into transportation, manufacturing, heating, food production, almost everything you and I take for granted. So when tensions rise here, oil futures don't wait for physical disruption. They price the probability of disruption. Now, what changed this weekend? We saw direct escalation between the key regional actors. We saw defensive and naval positioning increase, and we saw the rhetoric move from contained tension to open conflict. That shift matters, not because supply has been cut off, it hasn't completely been cut off, but because the risk of interruption has increased exponentially. Markets don't always price confirmed damage. They price rising probability. And that probability adjustment is what drove the immediate move in energy markets. So the question now is not, did something break? The question is, will this remain contained, or does it threaten the stability of the flow of oil and energy? Because that's the transmission channel. That's what global markets really care about. So what you're seeing here is the classic first 48-hour response when geopolitical risk escalates. Capital doesn't debate, it rotates, and it does so quickly. On the left-hand side, commodities, Brent crude spiked sharply. In conflict scenarios, the market immediately prices in potential supply disruption. Think shipping lanes, sanctions, production risk. Oil moves first because energy is the transmission mechanism in the global economy. Gold rallied aggressively, and this is a textbook safe haven behavior. When uncertainty rises, investors move towards assets with no counterparty risk. Gold benefits from capital preservation flows, not growth expectations. Silver followed, but with more volatility. Silver always behaves more aggressively than gold because it sits between a defensive metal and an industrial one. Then they got sold due to fear. The pain of January 2026 rebalancing of portfolios by the big boys still lingers fresh in the minds of investors. Now let's look to the right. Equities, on the other hand, saw broad selling, particularly tech. High growth names are typically the first to be reduced when volatility rises. Banking stocks came under real pressure as liquidity tightened and investors reassess economic growth expectations. At the same time, the VIX strengthened and the dollar firmed. This signaled a defensive positioning shift. And this is important. This isn't a collapse, it's rebalancing. When institutional portfolios detect rising uncertainty, they reduce exposure to cyclical risk and increase exposure to protection. It's all about protecting capital. It's systematic, it's structured, it's repeatable. The question now becomes whether this is a temporary adjustment or the beginning of a sustained macro repricing. So if there's one asset that matters most in geopolitical escalation, it's oil. It's not gold or equities. It's plain old black gold, and that's oil. Because oil is not just a commodity. It's an inflation transmission mechanism. If spot prices move towards the dreaded $120 a barrel level or higher, the impact spreads rapidly through the global economy. First, inflation pressure. Energy feeds directly into CPI and PPI baskets. When crude spikes, fuel, transportation, production costs rise almost immediately. That creates direct upward pressure on headline inflation. Second, central bank policy. If oil remains elevated, rate cuts get delayed. The higher for longer narrative returns. Policymakers cannot ease aggressively if energy-driven inflation resurfaces. That shifts bond yields and equity valuation. Thirdly, the consumer shock. Higher gas, heating costs, and oil costs reduce disposable income. When households spend more on energy and fuel, they spend less elsewhere. That hits retail, discretionary sectors, and broader growth. And fourth, corporate margin compression. Companies absorb higher input costs. If they can't pass those costs through to the end consumer, you and I, earnings come under pressure. That affects equity multiples really, really quickly. And the chart on the right shows clearly, historically, when oil prices spike towards extreme levels, inflation follows. It also tends to spike and follow at a lag. This is why oil is really the wild card in this equation. Gold protects capital, oil changes the macro regime. If energy stays elevated, it's no longer just a short-term market shock. It becomes an inflation narrative all over again. And that would reshape the entire rate outlook. So when the unrest first escalated, gold, silver, and platinum all spiked sharply. The first move was purely mechanical. It was the fear premium being priced in. In moments of geopolitical shock, capital doesn't sit and analyze every nuance. It relocates really quickly. Institutions reduce equity exposure and increase allocation to hard assets. Gold gets bought because it carries no counterparty risk. Silver tends to move with it, but a bit more aggressively because it's thinner and more volatile. Platinum, on the other hand, initially rides the same wave simply because it sits within the precious metals complex. But that first spike is just phase one, the headline reaction. Then markets shift into phase two, which is the macro recalibration. And this is where things become a lot more interesting. Gold does not trade purely on fear. It trades primarily on risk yields and the US dollar. When oil spikes during a conflict, markets begin to reassess inflation. And when they look at those expectations, if energy remains elevated, central banks may delay rate cuts. When that thought enters the system, nominal yields can rise really quickly. If yields rise faster than inflation expectations, real yields rise, and that puts pressure on gold. At the same time, the dollar often strengthens in periods of global stress. A stronger dollar also weighs on gold and silver prices. So even in a risk-off environment, metals can retrace all the way back down because the rate and currency dynamics start to dominate the conversation. This is also a liquidity component. When volatility increases and equities fall, some funds are forced to reduce their leverage. They sell what is highly liquid, and gold is highly liquid. But paradoxically, gold can be sold during times of stress, not because it's lost its safe haven role, but because it becomes a source of cash. Now we move into phase three, which is the divergence of gold, silver, and platinum, as they stop moving as one trade and start responding to their underlying economic drivers. Gold remains the pure safe haven asset. It reflects capital protection, central bank demand, and the real yield environment. If uncertainty persists but yields stabilize, gold can regain its strength. Silver, on the other hand, is different. It's part monetary hedge and part industrial metal. If the market begins to worry about a slower global growth, especially the higher oil prices, silver can underperform gold because its industrial demand component becomes a headwind. Platinum is even more growth sensitive. It is closely tied to industrial production and automotive demand. If energy prices remain high and growth expectations weaken, platinum may struggle even if gold holds firm. That's why you begin to see separation within these metals complex. So the pattern you're witnessing is not random. The first spike was fear driven. The pullback was yield and liquidity driven. And the divergence will be growth driven. Markets evolve in phases. And once the initial shock fades, fundamentals tend to take over from emotion. The critical variable from here is the path of real yields and the dollar. If they stabilize, growth can reassert itself. If they continue rising, pressure remains. And platinum will continue to trade the geopolitical growth outlook more than the other metals. One of the biggest misconceptions during geopolitical shocks is that money is leaving the market. It isn't. Capital doesn't disappear, it rotates. What we're seeing here is not a collapse, it's a reallocation of risk. When uncertainty rises, institutional investors don't move to cash entirely. They shift exposure towards sectors that benefit from the new macro backdrop. So look at the winners, energy stocks, particularly producers and exploration companies, tend to benefit immediately from higher oil prices. If crude continues to rise, their revenue and margin outlooks improves almost instantly. Defense and aerospace contractors often see inflows because geopolitical tension increases the probability of elevated defense spending. Growth and precious metal miners benefit not just from higher gold prices, but operational leverage. When gold rises, mining equities often move more than the underlying metal because of margin expansion. Now contrast that with the sectors under pressure. Banking and financial services tend to weaken in this kind of environment. Higher volatility tightens liquidity. It tightens loan expectations, which begin to soften. And if oil drives inflation higher, rate cut optimism fades. High growth technology stocks, particularly longer duration assets with big capex spends, are sensitive to interest rate expectations. If yields rise and remain elevated, valuation multiples tend to compress. Consumer cyclicals come under pressure because higher energy prices reduce disposable income. You've just got less money in your pocket. So this isn't panic selling. It's repricing based on macro sensitivity. Each sector has a different relationship to oil, inflation, interest rates, growth expectations. Markets are constantly adjusting to those relationships in real time. And what the heat map shows is exactly that: red in sensitive and growth sensitive sectors, green in hard assets and defensive exposures. During escalation, capital moves towards cash generating assets and real asset backed sectors and away from duration and leverage. If tensions ease, that rotation can reverse just as quickly. But for now, this is not a market in free fall. It's a market relocating around a new risk regime. So up to this point, we've analyzed the reaction. Now we need to think in probabilities. Markets don't price certainty, they price scenarios. The big banks and hedge funds have entire departments conducting scenario analysis. So I've analyzed this scenario for us, and my opinion is that there are three realistic paths. Let's start with the least likely but most bullish outcome. Scenario one: rapid de-escalation with roughly a 20% probability. If diplomatic signals emerge quickly and tensions ease, the risk premium that has been priced into oil would just unwind. Oil could retrace back to the 80s, maybe lower to the $60 a barrel. Gold would likely see a safe haven flow, particularly tech and financials would rebound sharply. Volatility would compress aggressively. And this would look like a classic relief rally. High beta assets will tend to outperform and duration trades will recover. But that requires a swift containment. Now, the base case, which is prolonged tension, sits at around maybe 50% probability. This is a couple of weeks to maybe a couple of months. This is often how modern conflicts evolve. Not full escalation or immediate resolution, just persistent uncertainty for a while. In this environment, oil would tend to be elevated, perhaps shifting into the $80 to $100 barrel range, but doesn't explode any higher. Gold kind of stays supported at a floor because the uncertainty remains unresolved. Equity markets may struggle to establish a trend. They may move sideways with sharp rotations between sectors. Volatility stays elevated, but doesn't spiral out of control. This scenario tends to produce very choppy markets and not crashes, but generally this is where investors tend to lose most of their money, trying to second guess what the market's actually doing when there's a lack of direction. Capital continues to rotate rather than completely exit. And so that's kind of a sideways scenario. It's probably most likely. Now, major escalation is roughly 30% probability. If supply routes are materially disrupted, particularly energy routes, oil could spike sharply towards the $120 a barrel or even higher. At that level, energy becomes an inflation shock to the system. Rate cuts get delayed, rates might even go up, bond yields rise, equity multiples compress, and broad risk assets sell off more aggressively. Gold may benefit again initially, but substantially would depend on real yields. If yields rise sharply, even gold can struggle. In this scenario, we move from rotation to a complete repricing. So what matters from here? Oil. If oil stabilizes, markets can absorb this. If oil accelerates, then everything shifts. The key variable is not the headline, It's the inflation channel. Because once inflation expectations reprice, central bank policy reprices, and then asset valuations reprice. That's the chain of reaction that we need to watch out for. Right now, the most important thing is not to react emotionally to headlines. I remember one of my mentors telling me, just sit back, Ravi, and think logically. Whenever there's a crisis, the internet fills up with fear and speculation and people predicting the end of the world. But markets don't actually move on panic. They move on real signals. So instead of chasing news, here are a few things I'm watching for very closely. Firstly, oil prices. Oil is incredibly important because it flows through the entire global economy. If oil stays relatively stable, the economic impact is usually manageable. If oil suddenly jumps higher and higher and stays there, that can push inflation all the way up and start affecting everything from transport to food prices. Secondly, gold. Gold is often seen as the safe place for money when people feel uncertain. If gold keeps rising strongly, it could mean investors are looking for protection. But if gold struggles to move higher, it suggests that markets are still relatively calm underneath the headlines. Third, US government bond yields, especially the 10-year. When investors get really nervous, they often move money into government bonds because they're considered safer. That normally pushes yields lower. But if yields rise instead, it can signal that inflation fears are building rather than pure panic. So the fourth thing I'm looking at is the US dollar. The dollar tends to strengthen when global uncertainty rises. A stronger dollar can tighten financial conditions around the world and put real pressure on many markets, especially emerging markets like South Africa. Fifth is volatility and sector movement in stocks. Are investors running towards safer companies like healthcare and utility, or are they still comfortable buying growth and technology stocks? That tells you a lot about how serious the market believes the situation is. And finally, listen carefully to what the central banks are saying. If they start talking about emergency support and liquidity and delayed policies, that can shift the entire market narrative very quickly. But through all of this, the key is discipline and logic over emotion. Markets often overreact in both directions. Your edge isn't predicting every headline, it's understanding the key signals that drive the underlying system: oil, interest rates, the dollar, and market volatility. Watch those carefully, and the noise becomes much easier to understand. As we wrap this up, there's something important to remember. Markets will always react to uncertainty. They overshoot, they price fear in, they price headlines in, and then over time, they reprice reality. Our job isn't to panic when volatility rises. Our job is to observe, to stay calm, to understand the real transmission mechanisms running the global economy: oil, yields, the dollar, and volatility, and to recognize that capital just doesn't simply disappear, it merely rotates. And the investors who stay disciplined when emotion is loud are the ones who navigate these periods the best. But beyond the markets, we should also remember something bigger. Behind every headline, every chart, every price move, there are real people out there who are affected. Families, communities, entire regions dealing with uncertainty that goes far beyond simple markets. So, wherever you are watching this from around the world, I hope that your families are safe. And to those directly affected by the events unfolding in the Middle East, our thoughts are with you. Take care of yourselves, take care of one another, and we genuinely hope for stability and peace in the region. Markets will eventually recover. They always do. What matters most is that people do too. If you found this analysis helpful, I'll be producing many more videos like this, breaking down markets in a clear, calm, and logical manner. You can join the community at capitalist.com with a Z, where we go deeper into market strategy, investing frameworks, and disciplined decision making that's logical. And if you'd like to stay updated, make sure you subscribe to the channel so you don't miss the next analysis. Thank you for watching, and hopefully, the next time we speak, it will be under better circumstances. Invest smarter, build wealth, and live free. I'm Ravi Naika, the capitalist.